If you've just joined us, you're still watching Business Morning on Channels Television, and our focus has been on the banking industry, looking at the designated banks, the banks designated as too big to fail. And I still have here with me Mr. Johnson Chukwu, the CEO, Cowrie Assets Management, and of course there in our Abuja studio I have the Director, Banking Supervision, Mrs. Agnes Tokunbo-Martins. Well, back to you, Mrs. Martins. Now you have 8 banks designated as too big to fail. Of course, I believe the regulator should, of course, establish a critical monitor on these banks. What are the mechanisms the Apex Bank have put aside to monitor these banks?
Well, we monitor all banks on-site and off-site. That means we go to the field to monitor, and they also render returns. But for these systemically important banks, we will be visiting them more frequently, and the frequency of their returns will also be higher. You know, it's interesting that it's not really being a systemically important bank is not something that banks really want. If you look at other jurisdictions, because of the intensity of supervision that will be required just because you're systemically important, some banks prefer to stay beneath the threshold. Actually, you find that the whole idea of this framework internationally is to discourage banks that are already systemically important from becoming more systemically important and, causing problems for the economy. You'd find that in an economy like the United States, for instance, if you're already 10% of the economy or of the industry, you're no longer allowed to grow by acquisition. You can only grow organically. So back to your question, we will be examining them more frequently and more intrusively, and the rendering of returns will be more frequent.
All right. Now back to you, Johnson. Well, you heard what she said. Of course, we're talking about the mechanism really put in place by the CBN to monitor these banks, and she says, of course, a regular visit. Is that enough?
Well, I think I always believe that the regulator should adopt the benefits of technology to do some of these things. Under the reporting system, the monthly return rendition system that banks are supposed to render returns to central bank has been automated. So banks now forward their returns electronically. You can also ask the banks that at the close of every business day that they should, because the banks are all automated. They all have a banking system, application system that at the end of every business day they have their P&L, the balance sheet, and every other thing. So the central bank can also ask any bank they want to monitor on a daily basis to render returns on a daily basis, and those returns can actually be rendered at the click of a button. So I think beyond the issue of on-site and off-site supervision, because the on-site supervision sometimes could be disruptive. Whenever central bank officials, examiners come around, you find that the banks keep running around to meet their request. But a lot of these things can actually be automated, and then you could have a daily monitoring of those banks. So I think that's what central banks should actually do, because they already have this infrastructure in place. Like I said, the monthly returns are rendered electronically, and there's nothing that stops central bank from requesting these banks to render daily returns. And because once they render those returns, the system in central bank can actually compute the ratios. Okay, once the returns come, there's already a format that helps the regulators to monitor the ratios. Yeah, but
with this development there, she's even saying that they will be expecting higher returns from these banks, and that was exactly what the point I was trying to make about, putting pressure on these banks.
That's why I said that if you have the online report rendition, it will not be as disruptive when you have more frequent on-site supervision, and that will also give the central bank a tap. So when there's a major change in any of the ratios, it will trigger them to ask questions, and if they're not satisfied with those questions, that's when they can send the on-site examiners to go and find out what's happening.
All right. She also talked about making sure that the banks, seen as systematically important, not becoming more systematically important. Could you expatiate on that, please?
Well, I think she did give an example of the U.S. The U.S. case is a case of antitrust. What is the U.S. government? The antitrust law in U.S. stipulate that no particular institution should control beyond a certain percentage of the business activities in the industry, so that organization does not get to a point where it could stifle competition because it has the size to do that. And that's why when you achieve that threshold, you are no longer allowed to acquire companies to grow further inorganically to acquire other companies. And a classical example was in the case of US, the antitrust law can actually compel you to break up. We know the bells. Okay, of course, the bell. That's one of the most pronounced cases where the antitrust law requested that they should break up the operation to set up telecom companies. And I remember in the 90s, there was a time the antitrust law was beaming its light on Microsoft, because Microsoft was also getting too big, and it was felt that they will even stifle industry innovation. So the case of the US, when a bank has attained 10% of market share, and the law stipulates that you can no longer grow by acquiring additional other banks. So it's basically as part of that the antitrust law policy.
All right. Now, Mrs. Martins, I remember in the report and the reactions from the Deputy Governor Operations, Mr. Tunde Lemo. He did advise that these banks should actually raise their capital base. Now, what kind of capital base are we expected to see?
During the crisis, you'll find that quite a lot of some banks reported high capital, but during the crisis, this capital was found not to be able to absorb losses. So what we require banks to have is capital, common equity capital, that has high loss absorbency, so that in the event of serious unexpected losses, they have enough capital to absorb those losses. Now that kind of capital is equity, not long-term loans, because long-term loans, they mature and you have to pay them back. But equity capital, all you have is a residual interest. Other creditors have to be paid and the depositors have to be paid before an equity holder gets paid. So the kind of capital we're talking about here is common equity tier 1, which has just a residual interest in the bank.
All right, thank you. Mr. Johnson, talking about capital equity requirement, common equity capital, how would you react to that?
Well, what Mrs. Martin is saying is actually a fact. In the case of common equity, which is the share capital, the equity share capital, that's the residual owner of the company. In terms of liquidation, it's only after every stakeholder has been paid that the equity shareholder will get any residual payment. But above all, the equity shareholding acts as a buffer to absorb losses if the institution is making losses. Unlike when you have the second tier capital, the tier 2 capital, which are in terms of things like bonds, which have maturity dates. And it simply means that if you are relying so much on your tier 2 capital and the maturity date gets to the maturity date, the financial institution will have to pay off those bondholders with its liquidity. But the equity share capital is in perpetuity. And interestingly, in Nigeria, the law does not allow for companies to buy back their shares today. Okay, so because there are no issues of share cancellation, even if the countries where you have that allow for share cancellation, the process of getting approval for share cancellation is very cumbersome. So you find out that the perpetuity nature of equity shares makes it serve as the last buffer for all those who are creditors to the financial institution, particularly the depositors and every other lender to the financial institution. And the larger that equity capital is, the more the bank's capacity to absorb losses, and also the higher the probability that they will be able to pay off lenders or depositors if there are difficulties.
All right, it's not like one of the banking consolidation we had during Soludo's time, that banks were asked to raise to 25 billion and all that. It's not the same thing.
Well, I won't say it's not the same thing. What they are saying is this, in this instance, that the tier 1 capital should be higher, should be a proportion of the entire capital base. So if, for instance, a bank has 100 billion, okay, that the tier 1 capital should be something like 75% of that. So the equity capital, that portion of the capital that cannot be paid back, that the owners have the limit, can only make claims when every other claimant has been paid, should be higher in the share capital. What happened in the case of 2005 and 2006 was every bank was asked to move their capital base, which then was 2 billion to 25 billion. So it was a case of one size fits all. It doesn't mean they had no benefits. Of course, the crisis we had, if that consolidation did not take place, I don't think any bank would have survived, because the banks that had largest shareholder capital had less than 10 billion as at that then. But unlike when the crisis came, some banks were already having in the neighborhood of 100 billion naira in share capital. But what the central bank is doing is what like I said earlier, is an instance where it's going to be risk-based capital requirement. So the capital you carry will be based on the quality type of risk you carry, and the higher the risk you carry, the higher the more you'll be required, the more capital you'll be required to carry. And that's unlike what I said. The 2005-2006 consolidation was a one size fits all, irrespective of the size of risk you were carrying, that you needed to carry the same level of capital. Of course, subsequently it was tiered, and then we had banks that were going to international to have 50 billion and all the rest. But right now, beyond being an international bank, you also have to look at it, which is why you talk of capital adequacy ratio. You have to look at it, what kind of risk do you carry? And what the central bank has also done now with the systemically important banks is that for those banks, they will also require them to have slightly higher level of capitalization or slightly higher level of liquidity, so that the likelihood that little shock will adversely affect them will be moderated.
All right. Now back to you, Mrs. Martins. Now these banks that are said to be systematically important account for 75% of the banking sector. Now what happens to the rest of them?
Sorry, what happens in terms of?
What happens to the rest of them? Where do we leave? Where does that leave the rest of them?
They're all equally important, like I already explained.
Okay, now back to you, Mr. Johnson. Do you foresee, because we have about 84?
We have about
23 banks
yes.
now. Do you foresee the CBN shrinking the banks further?
Well, that possibility exists, because there are 3 banks that are currently owned by AMCON, and those 3 banks are on the block. For instance, Enterprise Bank is now in the process of being sold. You still have the Keystone Bank, you also have Main Street banks. If these banks are sold to existing banks, then you have shrunk the space further. But they have also created a window for the license of new banks. We know Merchant Bank has joined in the banking system. We know FSDH has converted to FSDH Merchant Bank, and we know a couple of financial institutions are applying or in the course of getting an investment bank or merchant banking license. So, in as much as there's a possibility that this number of existing banks today could shrink, there also a new window has also been opened for licensing of new banks. So the basic thing is it should be a free market economy. We should allow free entry and free exit, in as much as we impose constraints because of the unique and pervasive nature of banking business in the economy.
All right, and now to you, Mrs. Martins. Are we likely to see, well, you heard Johnson, but I want to put it to you. You are the regulator. Are we likely to see kind of mergers and acquisitions soon in the banking sector again?
Well, what I can say is that, just like he said, we have a lot of banks that are interested in coming into this economy. The economy is growing. There's still a lot of space for more banking services. We have 3 AMCOM banks that are going to be sold, and a lot of investors are showing interest in it. So the banking sector, I think, it has a lot of potential and a lot of space to grow further.
All right. Going forward, what should we be expecting from the banking sector?
We should be expecting the banking sector to lend more to the real economy. Already they have started doing that. This month, compared to last month, credit grew by about 18%. And we're doing everything possible to encourage it to grow more than that. So we actually expect to see all our policies are all tailored towards ensuring that banks focus on their core mission, which is intermediation. We really want them to mediate from those people that to do the maturity transformation and the risk transformation that they were actually set up to do. So we expect to continue to have a positive impact from banks on the economy going forward.
All right, thank you very much, Mrs. Agnes Tokunbo-Martins. So we're going to leave it there with you. But back to you, Johnson. What are your expectations going forward? I mean, 2013, it's almost over. What are your expectations in that sector?
Well, I think the banking sector has the upside potential in the banking industry is quite strong, to the extent that new opportunities for provision of banking services are opening up. The power sector will provide a lot of lending opportunity for the banking sector, and the power sector will also catalyze other sectors of the economy that also present lending opportunity for the banking sector. I think, if you ask me, I believe the upside potentials of the banking system is quite strong. The key challenge we have is that the Monetary Policy Committee said at the last meeting that the tendency for further contraction, monetary policy contraction, is still there, and that could lead to higher the interest rate moving northwards. And one of the challenges that this sector has had so far is that rates are beyond the level that you can borrow for this sector activity. So the challenge we have is that the regulators must find a middle course to ensure that interest rates begin to move southwards, so that the risk sector can afford to borrow for economic activities. All
right, thank you very much, Mr. Johnson Chukwu, and of course, Mrs. Agnes Tokunbo-Martins. Well, I've been speaking to this gentleman and lady out there who had Mrs. Agnes Tokunbo-Martins. She is the Director, Banking Supervision of the CBN, speaking to us from our Abuja studio. And of course, here with me is Mr. Johnson Chukwu, the CEO, Carry Assets Management Limited. And with that, we say thank you for being part of today's program. Do remember to join us again, same time tomorrow. Have a beautiful day.